Okay, so picture a machine, a really, really big machine.
Mm-hmm.
This machine is responsible for keeping the lights on for about a third of a country the size of Brazil. It manages enough wire to wrap around the planet. Twice.
It's a total beast. We're looking at the absolute giant of Latin American energy.
Right.
But the year we're tearing apart today, 2021, it wasn't some victory lap. This company was turning 60, but instead of a birthday party, they were basically fighting for survival.
Yeah, checking my notes here. They support 13,000 direct jobs, manage nearly half the national grid, but in 2021 they were sailing directly into what their own report calls a legislative storm.
And an actual storm, well, the opposite of a storm, a drought.
So today's mission,
Oh.
we are unpacking the 2021 annual report of this energy titan. We're going to figure out how a company that is 97% green navigated the worst drought in a century.
While also trying to convince the government to sell it off. It's a case study in financial resilience meeting, well, operational chaos. And honestly, it's a masterclass in crisis management.
Okay, let's start with the cash, because that's what jumped out at me first. I'm looking at the top line net operating revenue, $37,616 million. That is a 29% jump from the year before.
It's a huge jump.
And the adjusted EBITDA, which, for you listening, is basically just how much cash the business machine spits out before all the accountants get involved, that surged to over $15,132 million, up 44%.
Yeah.
If I only showed you those two numbers, you'd think they had the easiest year ever.
You absolutely would. You'd assume, perfect weather, full reservoirs, easy money. But that is why you can't just read the headlines.
Okay.
Because if you scroll down to the actual bottom line, the net income, it tells a completely different story. It dropped 11%.
Right, down to $5,714 million. So
Yeah.
hold on. They made way more money selling electricity, but they kept less of it. Where did that money go? Did they, lose it?
They didn't lose it. They used it. They used it to buy certainty.
Certainty.
This is the first big insight of the deep dive. That drop in income was largely due to a massive provision. We're talking $4,266 million here, related to something called GSF, or renegotiation of hydrological risk.
Okay, hydrological risk sounds like something you buy insurance for, but a provision usually means setting money aside for bad news, right? Can you break that down?
Think of it as settling a massive decade-long lawsuit out of court. The company operates these huge hydro plants, specifically Tucuruí, Curuúna, and Mascarenas de Moraes.
Right.
For years, there were these disputes with regulators about who pays the bill when it just doesn't rain enough to generate the power they promise.
The entitlement issue I saw in the report.
Exactly, the loss of entitlement. So by taking this $4,266 million hit in 2021, they were essentially paying to make all those disputes just go away. They extended their licenses to operate in exchange for eating this cost right now.
So they took a punch to the face in 2021 so they wouldn't have to worry about it for the next 10 years.
Precisely. They cleared the decks. It hurt the 2021 numbers, sure, but it removed a massive question mark that had been hanging over their future. If you want to sell a company, you can't have billions in potential liabilities just sitting there.
That feels like a very private sector move for a state-owned company. Take the pain now, grow later.
Well, looking at their debt, they were definitely acting like they had Wall Street watching. Their net debt to EBITDA ratio was 1.43 times. They beat their own target of 1.5.
And in plain English, that just means they aren't over-leveraged?
It means they're incredibly disciplined. They paid down about $706 million in debt during a crisis year.
Wow.
And don't forget, this is a company that also generated $10,073 million in taxes for the government.
$10,000 million in taxes.
That's 20% of their total revenue going straight back to the state. So financially, the ship was tight, but operationally, the ship was scraping the bottom of the river.
Okay, let's talk about that, the water crisis. The report calls it the worst drought in 90 years.
It was the defining struggle of the year. I mean, you have to remember, this company is water. Their whole business model is gravity and rain. When the rain stops, the fuel stops.
So what happens? Does the grid just brown out?
In the old days, maybe. But this is where their size saved them. They use that massive transmission network, the wires that wrap the earth twice to shift power around. But even that wasn't enough.
So they had to do the one thing a hydro company hates doing.
Burn stuff.
Right.
Exactly. They had to dispatch thermal power plants, gas, coal, diesel, and that is expensive.
How expensive are we talking?
Well, they also had to import power. They were buying electricity from Uruguay just to let the Brazilian reservoirs rest. That import bill alone added $1,222 million to their costs.
Wait, pause there. They paid $1,222 million to import power just to keep water in the river. That sounds totally backwards. Why not just use the water you have?
It does, right, but you have to think of the water in the reservoir as a battery. If you drain it to zero and the drought continues, you have nothing left. The grid collapses completely.
Ah.
So they paid a premium for Uruguayan energy just to keep some water in the dams as an emergency reserve. It's a desperate move, but a necessary one to ensure security.
That is wild. It really highlights how vulnerable these green grids can be.
Yeah.
You can have the best dams in the world, but you can't print rain.
And that leads perfectly into the second part of that financial hit we talked about, that $4 billion provision. A lot of that was tied to this reality. The rules for how much energy they were entitled to sell had to change because the physical reality of the rivers changed.
So the drought wasn't just an operational headache. It was a multi-billion-dollar legal headache.
Exactly.
Okay, so we have a company fighting a drought and cleaning up its balance sheet. But the biggest story of 2021 wasn't the water. It was the capitalization.
The privatization.
Right, and I feel like we hear about privatizations all the time. Government sells asset, raises cash. But the report treats this like a complete rewriting of the company's DNA. Why was this specific law 14182, such a big deal?
Because of the handcuffs.
The handcuffs.
As a state-owned enterprise or an SOE, the company was shackled by public sector borrowing limits. It doesn't matter how profitable you are. If the government says no new debt because of the national budget, you cannot build new plants, period.
So they were rich, but they weren't allowed to spend their own money.
In a nutshell, before this law passed, their investment capacity was capped at roughly $6 billion a year.
$6 billion. For a company this size, isn't that just maintenance?
It's basically painting the walls and fixing leaks. It's barely enough to keep the rust off. You certainly can't build a new nuclear plant or a giant wind farm on $6 billion a year.
And the new law changes that.
Drastically. The law allowed the federal government to dilute its stake from 51% down to 45%.
That's it. They sold 6% and that changed everything.
That 6% is the magic number. Once the government drops below 50%, the company is no longer an SOE. The public sector borrowing handcuffs just fall off.
Ah, okay. So it's not about the cash the government made from the sale. It's about the change in status.
Correct. Under the new private status, their investment capacity shot up from $6 billion to $48.3 billion.
Whoa. From 6 to 48. That's an 8 times increase.
That is an investment war chest. That is the difference between surviving and dominating. That's why management spent all of 2021 lobbying for this law. It wasn't just about ideology, it was about the ability to grow.
So they spent 2021 getting dressed for the party, cleaned up the debts, survived the drought, got the law passed, but they also did some housekeeping, right? The corporate reorganization.
Housekeeping is putting it mildly. They took a chainsaw to the bureaucracy.
The report mentions special purpose entities, or SPEs.
Yeah. In 2019, they had 136 of these SPEs, basically 136 mini companies, each with its own board, its own accounting, its own HR.
That sounds like a nightmare.
It's an efficiency killer. By the end of 2021, they had merged and slashed that number down to 81. They folded big subsidiaries like Amazonas GT directly into Eletrobras.
And the benefit is just fewer meetings.
Fewer meetings, yes, but also immense cost savings. The report notes that their PMSO expenses, personnel, materials, services stayed flat despite high inflation.
That's hard to do.
It's incredibly hard to do. It means they were cutting fat as fast as inflation was adding cost.
They were getting lean to prepare for the open market.
Yeah.
And they were just cutting, they were building. The third key event highlights infrastructure. We saw critical steps toward completing Angra 3.
The nuclear project.
A nuclear project
Yeah.
that has been a saga in itself. But also, they started operations at the Jaguari Dam.
Which is important because it reinforces that they aren't just managing old assets, they're bringing new capacity online. And Angra 3 is critical for national energy security because, unlike hydro, nuclear doesn't care if it rains. It provides that baseload stability the grid was desperate for during the drought.
Let's switch gears to ESG, environmental, social, and governance. And honestly, looking at the environmental section, I feel like I'm looking at a paradox.
It's the climate double-edged sword.
Right. On one page, they are high-fiving about green bonds. The subsidiary CGT Eletrosol issued the first green bonds raising $185 million for transmission projects. That's a badge of honor. Investors love it.
A huge win. It validates their commitment to sustainable infrastructure.
But then you flip the page, and their greenhouse gas emissions went up by 37%. 37%. For a company that markets itself as 97% clean energy, that number just sticks out like a sore thumb.
It is a shocking number. But we have to go back to the drought.
Okay.
This is the catch-22 of renewable energy. When the clean fuel water runs out, you have two choices. Let the country go dark or burn diesel and coal.
So to save the grid, they chose to pollute.
They had to. It wasn't negligence. It was physics. But it teaches us a scary lesson. Climate change causes droughts. Droughts kill hydro capacity. Low hydro capacity forces reliance on dirty backup power, which worsens climate change. It's a vicious cycle.
That is sobering. It really challenges the idea that hydro is always green. It's green until it's dry.
Exactly, and that is why they are diversifying. But before we get to the future, we have to look at the social side, because they did something in the Amazon that I think is genuinely fascinating.
The Decarbonizing Islanded Grids Initiative.
Yes.
I love that term. It sounds like sci-fi. But what is an islanded grid?
It's a town in the middle of the Amazon rainforest that isn't connected to the main wires. There's no plug. Historically, how do these towns get power?
I assume diesel generators.
Loud, smelly diesel generators. And just imagine the cost and carbon footprint of shipping diesel fuel up a river on a boat for hundreds of miles just to keep a refrigerator running.
Inefficient doesn't even begin to cover it.
So the company partnered with BNDES, the development bank, to swap those generators for renewables. Solar, small hydro. They targeted 257 of these systems.
That is a massive quality of life upgrade for those communities, and it cuts the local pollution.
It's a win-win. And it plays into the social aspect of ESG perfectly. They also vaccinated 95% of their workforce by the end of 2021 and donated oxygen to the state of Amazonas during that horrific crisis when the hospitals ran out.
Right, 2021 was still peak pandemic. I almost forgot amidst all the financial talk.
They had to show that even though they were becoming a private company, they were still a Brazilian institution that cared about the people.
And then there's governance. We talked about the reorg, but they also picked up some hardware.
Right.
The Pro Etica mark and the Transparency Trophy.
Which can sound like a participation award, but for a state-owned enterprise, it's gold. Investors are terrified of corruption in these big entities. Winning awards for ethics and rewriting their bylaws to match OECD guidelines. That was their way of saying to Wall Street, we are safe, you can put your money here, we are playing by international rules.
It was essentially dressing for the job they wanted, which was to be a private corporation.
Exactly.
So that was 2021, the year of survival, cleanup, and prep. Now let's look forward. They have this master plan, PDNG 2022-2026. They have the $48 billion war chest. Where is the money going?
Priority number one is that massive investment cycle. We're talking $48.3 billion. They're resuming growth in generation and transmission, modernizing aging assets, and finally pushing to finish Angra 3. This is about physical expansion.
Priority 2 seems to be about image and future-proofing. The net zero ambition.
It's more than image. They submitted studies to the board to define targets for becoming carbon neutral over 5, 10, and 15 years.
But wait, they're already 97% clean energy. How hard can the last 3% be?
The last mile is always the hardest. That last 3% is the thermal backup we talked about. To eliminate that, they have to invest in new technologies. The report specifically mentions green hydrogen, or H2V.
Green hydrogen. The fuel of the future that's always 5 years away.
They're betting it might be closer. Using their massive hydropower to split water and create clean fuel could be the key to replacing those diesel generators and thermal plants.
And finally, priority 3. Electricity trading leadership. This sounds like a shift in mindset.
It is the biggest cultural shift. For decades, they operated under a quota system regulated prices, guaranteed buyers, boring, safe, low margin.
Right.
Now they're moving into the free market. They want to be aggressive traders. They are looking for attractive margins.
That is corporate speak for, we want to make serious profit.
It is. They need to build a trading desk that can compete with the sharks in the private sector. It requires a completely different skill set. You aren't just an engineer anymore, you're a trader.
So pulling this all together, what are the big takeaways from this deep dive?
I think there are three main insights. First is financial resilience. We can't overlook that despite a historic drought and an 11% drop in net income, their EBITDA grew by 44%. The core engine of this business is incredibly cash generative. It prints money even when it doesn't rain.
Yeah, it is a strong foundation.
Second is the capitalization pivot. 2021 was the bridge year. The passing of that law changed the company from a state-constrained entity investing $6 billion a year to a potential market giant investing $48 billion. The handcuffs were taken off.
And the third.
The climate double-edged sword. Being 97% renewable is a fantastic marketing point, but that 37% emission spike proves that climate change poses a direct operational risk. When the water dries up, the company is forced to become what it hates, a polluter, just to keep the lights on.
It's a fragile balance. And that leads me to my big question for you and for you listening. As this company transitions to a private model with that massive $48 billion war chest, where does the money really go? Do they prioritize maximizing those trading margins to please their new shareholders? Or do they double down on the really expensive experimental technologies like green hydrogen to eliminate that final 3% of dirty energy?
That is the multi-billion-dollar question. Private shareholders usually want quarterly returns, but green hydrogen is a decade-long play.
It's the classic battle between profit now and sustainability later.
And for a company this size, the winner of that battle determines the energy future of an entire continent.
Well, on that heavy note, I'm still just trying to wrap my head around paying over $1 billion to import power just to keep river levels high.
It's the price of doing business when your business is nature.
Truly wild. Thanks for unpacking this with us.
My pleasure.
And thank you for listening to this deep dive. Let us know what you think. Profit or planet? See you on the next one.